Our next group up is our valuation group, and their presentation is titled Deal or No Deal. Our valuation group, of course, does valuations of full business interests. They also do valuations of partial business interests, and there's some other areas that they do work in as well that we want you to know about. They often participate in purchase accounting exercises, including the valuation of intangibles that are part of acquisitions. They serve ESOPs and do valuations for ESOP companies, and that's become a larger part of that particular practice. They also, even though our group is titled the Valuation Services Group, provide support to attorneys where there is a dispute that involves damages or requires calculations of damages. So we just wanted to let you know about that in the event that you need assistance in those areas. Today, though, Melissa Bizyak, and Brad Matthews will be talking about valuation considerations in transactions and sticking with the fact that we're talking about acquisition and sale transactions. So please welcome Melissa Bizyak and Brad Matthews.
Thank you, John. We both have clickers?
I think so.
I don't know how to work this clicker, guys. You can work the clicker. Well, if you guys hearken back to quite a few CPE days, when Don ever asked for a minute, he got a lot. It just reminded me of when my kids would be like, "Mom, let's go," and I said, "Give me a minute." 10 minutes, 15 minutes, 20 minutes later, I'd come out. One's asleep on the couch, the other one's on his phone. So, Don, wherever you are, I'm really, really proud of you today, because it was a minute and 30 seconds. Like John said, valuation group, we're working often with sellers in advance of selling their company. Looking back to prior CPE days, we talked about exit planning, working with clients, putting a value on their company at a particular point in time, and then working on what we call value enhancement initiatives. And those value enhancement initiatives eventually and hopefully can get the future sellers to a place that they had expected perhaps at the outset. So do a considerable amount of that work, either working with GYF, current GYF clients, and a significant amount of our clients are actually outside of recurring GYF clients. We also work on the buy side. We have a lot of clients that come to us and say, "Hey, I'm looking to buy a business. I have no idea, what the price should be." So we often take a look at that for our clients as well. All afterwards, encouraging certainly getting buy and sell side due diligence in the entire process. But what's neat about our group is, we work on the front end, but we also work on the back end. As John said, we do a lot of purchase price allocation work. So some of the trends that we tend to see, in the past, large amount going down in that residual bucket of goodwill. You see times like this, maybe goodwill is squeezed a little bit in terms of purchase price. Multiples are, we'll talk about today, multiples are a little bit lower. So you'll see that goodwill shrinking. Oftentimes, as our outside speaker said on ethics, oftentimes we have purchase price allocations that were based on purchase prices that were driven by ego. So regardless of what's going on out in the world and in the market, sometimes you see a big chunk of goodwill. The other thing I would mention, our group actively participates in the ESOP community. So typically we're engaged by the ESOP trustee to do the valuation work on behalf of the future participants of the ESOP and that ESOP trust. And I will tell you that those transactions are very much like live third-party transactions, even though it's between the current ownership of the business and a ESOP trust. So just a very neat dynamic. We're around to talk about any and everything that we do after the program today, but just some opening comments. What we see is players in the M&A market, whether it's now or in the past, during very tough times when they emerge from a period of memorable volatility and uncertainty, I believe that they all have one common trait, and that trait is boldness. And that should not be mistaken with recklessness. And that's something that I think our team had addressed this morning with, it's fine to be bold, but doing that measurably and certainly not recklessly. Transactions still remain essential for growth in most industries. And both private equity firms and corporations, companies, believe that the transaction outcomes are highly dependent on effective transformation planning and execution. That's something that we'll talk a little bit about today, but I know that my colleagues have talked about that effective planning, and certainly I think the buzz term out there now is transformational planning based on the landscape that we have right now. So we'll talk briefly about what we're seeing thus far in 2023. We'll talk about some deal terms, some multiples that are of interest, and then we'll kind of end things with, and Brad leading most of that discussion on what we're seeing in terms of valuation, both from a numerator perspective in the future earnings, as well as the denominator perspective, and that is the risk rate. And we'll look at that risk rate from a couple of angles. So deal valuations we know fell dramatically, but yet those valuations are hovering above the trough or above the typical downturn trough. So they're not in the basement. We know that in the fight against inflation, central banks are raising interest rates. So I just read something a couple hours ago that said that the Feds might hike the rate up to a new 22-year high to 5.75%. So we know that elevated inflation is going to mean that central banks may have to keep rates higher in a way that stretches the capacity of buyers to repay. Low unemployment rates challenge some sectors, while layoffs have accelerated in big tech and financial services. In turn, this has allowed some savvy companies to be more selective and certainly improve the quality of some of their new hires. But still, looking at transactions, employees and workforce dynamics are very much a wild card, as we know, in potential deals. We also know that inflation has slowed, but still persists. And deal makers obviously are struggling to get deals done. As we know, and oftentimes, or most times, there's a disparity between sellers and buyers' pricing expectations. Buyers are extending their due diligence work, making sure that there aren't too many issues to face on the back end. Private equity exits have dried up momentarily, and corporate divestitures have slowed. As always, a lot of things that we're going to talk about today, will vary by industry. So these conditions, as we discuss, will certainly vary, as everybody knows. Deals have paused slightly, but we don't think, and I think a lot of commentators out there do not think that the M&A era is over yet. Although we have faced unprecedented headwinds, we feel that there have been many silver linings that have been uncovered.
One of those silver linings is if you actually look at the Pittsburgh market, although we may see some kind of negatives in terms of deal terms, deal volumes, when we talk about kind of the national landscape, Pittsburgh market has actually fared and showed some resiliency. So year to date through the summer, deals are actually up almost, a little over 8% on a trailing 12-month basis. And then there are some notable transactions identified from local publications. Continuum Equity Partners purchased Dynamic in the manufacturing sector. Gray Matter Systems merged with Automation and Control Systems, which was their largest strategic merger to date. So there are deals to be had out there, and there are local deals to be had out there. Nortap Technology acquired Epic Photo Ops, expanding experience capabilities for event organizers. So even though we paint with a pretty broad brush with the information that we have, locally we do see some bit of resiliency. We see a lot of the same things that you see nationwide. We'll talk about inflation, we'll talk about the labor markets, but you know, Pittsburgh is a resilient market to begin with, and we have seen that over the last 12 months. The next handful of slides that we're going to walk through, we're going to be looking at a source called GYF data. It's a commonly used source that we use in our valuations, and it presents deal terms and deal structures for completed transactions. It doesn't give you a lot of granular detail on a deal-by-deal basis, but what it does allow us to do is provide analysis, a high-level analysis of deals, deal terms, activity, multiples, and those kind of things. So what we're looking at here are number of deals, enterprise value to EBITDA multiples, and then some financing structure over the last 8 quarters. And you know, when I look at this chart, what I see is, you know, 4 quarters on the left side of the chart, pretty consistent in terms of where our multiples have been. But then in the last 4 quarters, our multiples have started going all over the place. And we'll see this in a few different instances. But the reason for that, we can break down a little bit more granularly when we talk about valuation, the pricing. But you know, any change in any of those valuation-related assumptions can cause increases and decreases in those multiples. And with all of these factors impacting us over the last 24 months, we're seeing it in the deal terms and the multiples themselves. The other thing that I'd specifically point out when I look at this chart is over the last 4 quarters, you're seeing a much lower, you're seeing a reduced amount of financing being brought to deals. So the total debt to EBITDA numbers, the senior debt to EBITDA numbers have each seen decreases. Now, obviously, I don't think it's a coincidence that this is going to align with the timing of increasing interest rates. More expensive to finance deals today than it was, you know, years ago. So we do see a lower level of financing being involved in these transactions, but it does create the ability for, you know, buyers to get a little bit more creative, which Melissa will touch on here in a second. Again, this next chart that we're going to look at, some high-level insights on closed and reported transactions that we see. We're looking at a little bit more granular of deal multiples specifically, enterprise value to EBITDA multiples. And really, when I look at this, I see in 2020, pretty much across the board, multiples had decreased. Makes sense, right? Like, what were we doing in 2020? Everybody was sitting at home washing their hands, not knowing what was in store the next day. 2021, we see the opposite. We see an increase in those multiples. But then, you know, in line with what we saw on the last slide, 22, 23, results are a little bit more mixed. You know, this is based on size. The different rows are, you know, smaller to larger from top to bottom. So mixed bag in terms of where those multiples have gone in the last handful of years, but you know, a lot of that has to do with all of these moving parts that we're going to talk about that are going to impact that pricing. In terms of volume, 2019, 2020, fairly consistent volume of transactions that we've seen. 2021, we had quite the uptick in transaction volume. Again, what's that attributable towards? Probably getting a little bit more comfortable with the world that we are living in post-2020. 2022, we kind of came back to a consistent level. And then 2023, it looks like if you would extrapolate, it's only the first half of 2023, if you would extrapolate this across the whole year, it looks like deals are down. However, this may be a little bit deceiving. It takes a while for these multiples or these deals to get reported and included. So even though it makes it look like 2023 is quite the bad year, we saw Pittsburgh is doing well, even though nationally it might be a little bit below what we've seen historically. Not doing it. Got it that time.
Sorry, Brad. Not really anything new. Am I talking about this slide?
Sure, I'll back it up for you. Oh, we're playing games here.
Okay.
You got it.
Is that my slide? But not really anything new. Buyers or informed buyers, well-advised buyers are going to be adjusting deal terms. And if they're not, that's going to create a significant amount of issues in the aftermath of a transaction. But I'll go through a little bit of what we're seeing as far as indemnification, escrow, things like that. Indemnification caps, those things that limit the overall liabilities of the seller, had surged, obviously, in the first 6 months of 2023. What that reflects is that deals are taking longer to close. Buyers are going to be very, very concerned with erosion in the target company's financial statement. So you're seeing a lot of pumping of the brakes. Values will decline on deals without reps and warranty insurance, and I think that'll vary depending on in orders of magnitude of the transaction. The challenging debt market will lead to more deals, as it has in the past, requiring some type of bridge financing mechanism, whether that be seller financing, which we see a great deal in ESOP transactions. We see banks coming in 1.5 to 2 turns of EBITDA, and if it's a 100% leveraged transaction, the remainder will be taken on by the seller. Earnouts, nothing that we haven't seen in the past. I do see earnouts getting a little bit more creative and thoughtful during times like this, but basically the traditional means of using that bridge. And obviously, it's just remember at the closing of the deal, that's not the end of the challenge. Certainly for the buyer, it's certainly a beginning of another, as I think we've discussed a little bit this morning. In terms of, in this deal range from 10 to 500 million, indemnification caps, certainly are going to be soaring on smaller deals, perceived risk. So as you can see in the first half of 2023, small deals from 10 to 25 million are up quite substantially. And you can also see in the bucket of 50 to 100 million, we've gone from almost 10% indemnification caps to almost 22. So as you can see in the history here, with where we are at 21.3 across all deal sizes, that's a pretty substantial increase in terms of indemnification. When you increase the indemnification, you look at increasing the duration of the period as well. So we go from 21 days 21 months, I'm sorry, on average in 2022 up to, first half 2023 at 23.2. So, you haven't seen that in the most recent past as well. So, I think towards, what we're seeing is towards the end of the year that's going to lessen, but not substantially. When we look at escrow holdback periods, they're certainly lengthening. If there's a long survival period for certain indemnification claims, it'll require a portion to whatever degree to be in escrow, and escrow to be held longer. So as we can see, first half of 2023, not really terrible because we've seen actually greater periods in the past, but 15.2 months in terms of the length of the escrow and the holdback periods.
So this next couple slides, these are based on a Grant Thornton survey about transaction activity or forecast for transaction activity. I know we've been playing with this game show theme, and the survey says top industries for transaction activity. First one expected to be technology, media, entertainment. So in times of economic turmoil, one of the things that you commonly see is advertising revenue is probably something that's going to decrease. Companies a little bit more hesitant to spend that money. Part of it could be seen as a discretionary spend, something that could be cut back. So as that revenue was down during that economic turmoil, now companies are prepared to get deals done, whether that's in response to needing to drive up that revenue or a little bit more, not predatory, but I guess opportunistic. The banking industry, obviously we had a halt in activity within the banking industry because of the shock, the collapses from few banks, Silicon Valley Bank being the first. But now the industry is stabilized, and I think the reason that it's likely on the survey is that it's probably ready to resume some more deal making. And then the last one, healthcare. So when you think about healthcare, and we'll talk about the need for automation and AI. Healthcare is always identified as an industry where you need to see the most advanced technology. I have a 1-year-old at home. If he's sick, I don't want them using Stone Age technology to try and make him better. I want to make sure that the doctors are using the best available technology. But this is also further emphasized by the labor shortages. I'm sure you all are experiencing it with your businesses. The shortages, the labor, the cost of labor. A lot of that for many businesses, healthcare particularly, is going to drive the need for some type of automation, technological assist. The other thing I like to point out here, the survey was very polite. Healthcare has a strong supply of customers expected, which seems to be a very polite way to introduce the aging dynamics that we see across the United States. And the survey says industries forecasted to have the slowest rate of M&A activity. The first one, nonprofit higher education. As you can imagine, a little bit more difficult, at least it's perceived to be a little bit more difficult to get deals done in the non-for-profit sector when we have the lending environment that we have right now and some of the red tape that kind of surrounds those types of transactions. Hospitality and restaurants. So we obviously saw a decrease in the number of players in the hospitality and the restaurant industry during COVID. And then we have seen a shift in just the dynamics of that industry in general. More people prefer takeout. Just in general, less people want to actually sit down for the meal, more are willing to either cook at home or bring it home. It's also influenced by the fact that, again, the price of labor, the expected tips these days, a lot of people don't necessarily agree with the value that they're getting, so it has shifted the dynamics of that industry. And then transportation, logistics, warehousing. Anybody that has ties to this industry knows how difficult it is to find equipment, how costly it is to find equipment, the lead times associated with getting that equipment in place and operational just really make it difficult. So shifting gears a little bit, let's talk about the impact of valuation and kind of go back to the basics and understand how the impacts of valuation and pricing are going to have an impact on M&A activity. So every time we're up here, it seems like we bring up our basic valuation equation. Valuation is nothing more than a risk and reward analysis. So value can be defined as what is the economic benefit of ownership, usually measured in some type of earnings or cash flow, and what is the required rate of return that an investor would need, understanding the risks inherent in that investment. Said another way, in a way that has been discussed all morning, what is the expected earnings, and then what is the proper multiple to apply to that earnings. These are the same equation, just illustrated two different ways. Embedded within that market multiple, within that earnings multiple, is that risk analysis. So whether you're dividing by the rate of return, which is expressed as a percentage, or you're multiplying by some type of earnings multiple, it's all predicated upon what is the risk inherent in the business and what is the expected rate of return or the required rate of return. So first, let's talk about the first half of that equation, the expected benefit stream. The expected benefit stream really should be, what is the true return on investment if I'm looking at purchasing a business? So generally, we're going to start with EBITDA, right? So we've talked about that all morning. Mark talked about the need to get a clean EBITDA number. The reason being that expected revenue is operating expenses, normalized operating expenses, as Mark and Amber go through and cleanse that profit and loss statement. But also you have to consider, what is the capital investment required? What is the investment in capital assets? By nature, by definition, EBITDA does not include consideration of that capital investment. Depending on the industry, that could be very high or that might not be as high. What is the working capital investment? Is it an industry that has much larger working capital investment, maybe longer receivables, government contracts, those kind of things? Or is it an industry where working capital is pretty fluid and you don't see the growth in that balance sheet? You don't have a lot of your cash tied up in various places on the balance sheet. And then last but not least, not listed on here, but what are the tax considerations in terms of, as I'm running this business, whether it's a C corporation, whether it's a pass-through, where is Uncle Sam going to come into play and what portion of that earnings is he going to take out prior to me being able to understand my return on investment as a shareholder of the business, as an owner of the business.
Hey, Brad, before we move on, one of the comments I'd make relative to working capital is what we actually just visited a company that is part of this trend, but we're seeing a lot of companies, especially in distribution, where they overbought. So they have elevated inventory levels. So when we initially go in and we assess working capital, in the past we'd often say, well, you have a lot of excess working capital on your balance sheet in the form of inventory. But when you look at changing times and how companies are planning for future operations, we're often seeing a lot of inventory parked on the balance sheet.
So, what has impacted the benefit stream, and how has that then tied back to the M&A markets? The first one, I'm sure we're all aware of, inflation that we've seen in the last year. Has anybody gone to the dollar store lately? It's not a dollar anymore. That business model was destined to break at some point, right? But inflation is going to impact, our expected earnings in a number of different places. Where we see it a lot is obviously raw materials goods, a true increase in the price of what it costs to make what businesses are making. But then the other big piece is labor. It's expensive to find people, it's expensive to hire people, and it's expensive to employ people. So in a vacuum, however, inflation is a little bit unique though, because it emphasizes what is the company's ability to pass those price increases along to the customers. Some companies are going to have no problem absorbing that cost increase and rolling it into higher revenue, price increases to their customer. At the end of the day, that starting point, that EBITDA, hopefully shouldn't change. Other industries, you might see the company has to actually absorb some of those price increases, and it flows down to the bottom line in terms of EBITDA, in terms of that cash flow. Supply chain issues are another place that we see many of our clients have issues. So increased cost of sales, increased focus on those inventory controls. Like Melissa said, we see a number of our clients that are stocking up on inventory when it's available, because they'd rather invest in the inventory now at whatever price they need to invest in it to keep the customer. The customer is more important to them than the dollar for dollar price of that inventory. We're seeing a lot of delayed lead times, which causes delayed revenue recognition and delayed revenue generation. So again, going back to how does that impact our EBITDA, our benefit stream, delayed revenue recognition, delayed revenue generation is going to then emphasize, well, how much of your cost is fixed, how much of it goes out the door when the revenue comes in. So for companies that have high levels of fixed costs, that delay in revenue generation is a pretty large impact. Then scarcity of resources, the availability of resources, the pricing of those resources. So understand, whenever we're trying to get to what is that benefit stream, what is that normalized EBITDA that we can apply the multiple to, what of these is temporary and what of it is, long-term, what of it is permanent. So to the extent that we have these changes that are temporary, how do we map that out over the period by which we can get to a more normal level? To the extent that it's permanent, that's going to impact, obviously the price in our overall equation. If that's a permanent change, then our EBITDA is going to look very different than it has in the past.
The one thing I would say before we go to the required rate of return is that a lot of transactions, one of the motivations, I wouldn't say it's a leading motivation, one of the motivations is actually to acquire a workforce. And you look at that on the front end in terms of a deal, and then you look at it differently on the back end when you're doing the purchase price allocation. And the reason for that is the value of your workforce actually goes into goodwill. But what you're and now it's become kind of a meaningful number in that goodwill bucket, because when you look at the cost to recruit, hire, and train in current day dollars, it's very different than harkening back several years ago. So it's just kind of the connections that we are able to make both on the valuation side, and then we get to the purchase price allocation side. Talking about required rate of return, that's defined as that's going to be the minimum acceptable return of investment that's going to be sought by company or buyer when considering an investment opportunity. That required rate of return is very much buyer specific. It's based on their analysis of the risks and opportunities and any risk mitigation of the particular target. There is an inverse relationship between that rate of return and value. So the higher that rate of return is, it's signifying higher risk, the lower the valuation, and therefore the lower the transaction multiple. So remember, there's an inverse return, or an inverse relationship. And that's going to be influenced by, as I said, the perceived risks that are inherent in the investment community in terms of other opportunities that are out there, because you're always measuring, your pending transaction or your pending opportunity with what that opportunity cost would be, looking at other investments of equal utility. And I just talked, the second bullet point is speaking to what the opportunity cost is. And then those resultant risks and reward dynamics are obviously going to be built into the pricing determination. Changes in interest rates obviously are going to impact the potential return on not only what we're looking at for our potential target, but also those investment opportunities or alternatives. So as rates rise, investment opportunities maybe elsewhere become more attractive. There's no bidding up of prices because especially in the stock market, in the public stock market, they're not bidding up prices. Why is that? Because future earnings are translated to something less by virtue of present valuing those backed by a higher perceived discount rate or risk rate. The threshold for required return on equity investments will definitely increase as rates of return for alternative investments increase. Because what do we do when we're looking at a risk rate or a required rate of return for our investment? We're out there looking at what are the alternatives. We start out with a risk-free rate. If we were to invest in a long-term bond, what's the yield on that? We look at adding to that, what is the return on investing in the public markets, the S&P 500 broadly. We look at, okay, well we're not, our privately held company is not in line with that. What are the additional risks? Well, let's look at the smallest companies that are trading on the public exchange. And then on top of that, there's an additional risk that's very much specific to the company that we're looking to acquire. So there's a layering on of these risks and constantly weighing what those other opportunities or what that opportunity cost is. And looking at the lending environment, financing acquisitions, as we know, has become more costly, thus increasing the required rate of return. Shift in deal structure, which we've talked about earlier, definitely in recognition of the impact it has on valuation. This here is just, this next slide is simply an illustration that really shows, we go through sensitivity in all valuations that we do with our clients, sensitivity to movement in that risk rate. And we could be looking at various elements of the risk rate. We could be looking at specific company risk. We could be looking at future growth rates. But we're always looking at sensitivity to these rates. So here, very simply, if you look at what's bolded in the middle, you're looking at a $1 million cash flow. We're mapping in a 3% growth rate. And if we start with a discount rate of 23%, we're going to reduce that by the long-term sustainable growth rate, which is 3%. So that takes you to a 20% cap rate, which is essentially 5 times that $1 million, which leads to a $5 million valuation with that 5 times multiple. As you can see, as we move up on the scale in terms of looking at relative risk, going from 24% to even 26%, the value goes from around 4.8 million down to 4.3 million. And as you can see, those multiples then move in line accordingly. And that's kind of what we're seeing out there now, whether it's on either side of the equation, and sometimes it's both. It's looking at the risk associated with future cash flows that might be depressed for whatever reason or another. But that's just a simple illustration that Brad had put together that we usually talk to our clients about that inverse relationship.
So, as I said before, market multiples, that required rate of return, is the same analysis, just looked at, a slightly different way. Whereas the required rate of return for a buyer is buyer specific. If we're looking at multiples out in the marketplace, it gives you that market-based indication of how risk is perceived and priced by other people within the industry. So in a bidding scenario, it helps us determine where could prices go. What may the purchase price eventually need to be for me to win the bid to purchase this company. So it is interrelated with that required rate of return. It's really just a simplified calculation to streamline a much more complex analysis that happens for each one of these transactions. It's obviously measured as a resultant calculation. You take what was the purchase price, what was the final purchase price, what was the reported EBITDA, divide one by the other, that gives you the market-based multiple. It can be used to gauge, the temperature, the affordability, or opportunities within certain industries, and understand how expensive or how efficient you may be able to utilize capital to invest in various industries based on these completed transactions. Now, if using these market multiples as a guide to help price potential investment or potential acquisition, in volatile times like we've seen, I showed you those market multiples bouncing around over the last 24 months, focus needs to be on those most recent transactions. So if we're using market multiples, we have to look at those multiples that are the most representative of the current business climate. So in those volatile times, it needs to be more recent. A longer period of analysis could lead to those multiples not really incorporating those current market conditions. COVID is the easiest example of this. Would you pay the same multiple for a company prior to COVID that you would after? Maybe. I would argue it's probably unlikely. Dynamics have changed across many industries. So making sure that you're looking at examples at multiples that are representative of the issues that the business is facing today is the most important piece of that analysis. Those changes in market multiples, although in the opposite direction, should follow the changes that Melissa talked about in how we quantify that required rate of return. So we see how those impact the multiples measured after the fact, the market-based determination of how to price that EBITDA, how to price that earnings stream. So what are our expectations? How these items that we've identified, how are they going to impact pricing? How are they going to impact valuations? So interest rates, today the cost of doing business is higher than it's been in quite a while. Although, we're still below where we've seen in historical rates, the cost of business doing today is much higher than it was a year ago, 3 years ago, 5 years ago, 10 years ago. So the Fed, as Melissa said, isn't showing any indications of decreasing rates. Whether or not this is the new normal remains to be seen. We tend to believe that at some point interest rates will come back down, but it doesn't look like it's going to happen in the short term. There's no indication that it's going to happen in the short term. In terms of inflation, is the damage already done? We've seen easing of inflation, but again, prices are higher now than they were before. So that normalized EBITDA that we're trying to calculate, that we're trying to scrub to make sure that we understand the potential earnings of a business, should capture what that new level of cost, as well as what amount of that can be pushed to customers. So whether or not that's in line with historical levels of EBITDA is really something that needs to be fleshed out through the process. It's something that Mark and Amber talked about this morning. Again, can a business pass those costs along to the customers? How readily acceptable are customers to price increases in line with what you're seeing in terms of the cost increases from an operating perspective?
Just to mention labor markets, obviously, as labor markets remain tight, or as we talked about, become more expensive, we always look to automation. This is nothing new. We looked to automation after World War II. We looked to automation during the computer revolution in the 80s, and then certainly the start of the internet revolution. Obviously, there's a lot of upfront costs with respect to automation, a lot of neat things happening with AI. a lot of banter out there about AI, and certainly long-term benefits and maybe some challenges or scary things. But the one thing I would point out, if you think about this, there could be increased wage or income disparity or inequality, because when you think about it, automation typically will replace and supplant those low-costing wage people. But what it does at the same time is it provides opportunities for more skilled wage people. So you'll start to see that disparity even more. Other factors which everybody is aware of is the world, the world geopolitical climate, the 2024 election. Looking at changing dynamics, certainly in Washington, is going to bring other risks and hopefully opportunities. With respect to M&A activity, it's very difficult to predict the amount of activity. There are just so many things that are left uncertain. We're seeing a lot of conflicting macroeconomic drivers and certainly opinions. When we talk about the worldwide geopolitical uncertainty, those risks remain very prominent in Europe, Asia, and certainly elsewhere throughout the world. Varying levels of risk tolerance. These are very much buyer specific, with certainly looking at more adequate planning in advance of transactions, helping to ease that buyer perceived risk.
And so we talk about on the horizon and M&A activity, reiterate some of the stuff that we have heard this morning. We've seen that there remains dry powder on the sideline that is ready to be deployed. Balance sheets for a lot of companies are strong. They're strong and ready for future acquisition activity. And what that does is those factors combine to allow buyers to be a little bit more selective with that potential investments, with those potential acquisitions. They're able to deploy that capital, deploy that cash when the right opportunity finds itself. So we have seen this in a number of places. I know a number of our professionals have talked about this as well.
We also feel that creative deal structures will continue looking to earnouts, looking to other means to get a little creative with respect to getting a deal done, trying to kind of bridge the gap between buyers and sellers, looking at alternative ways to match buyers and sellers' desires. And we see, our colleagues see a lot of that in their transaction work. Earnouts, equity incentives, all those incentivize sellers to contribute to the continuity and performance. And that's a big deal. Trying to ease that transition going forward. There are a lot of ways that we can help our clients ensure that continuity.
And as Melissa said, on the horizon, this idea of technological incorporation and acquisition is going to continue. I still see that as really a function of the difficult labor market that we're all experiencing right now. So those investments are going to be focused on making sure that we have the best systems, the most efficient systems, and can automate where it makes sense to automate, where it makes sense to make that investment. But we also see an increase in ESG-focused investments, so environmental, social, and government-focused investments. There's been public demand for awareness of these issues, so investments in sustainability, investments in companies that are environmentally responsible, investments in companies that have criteria for assessing internal and external communications with their employees, with their customers. There's been a lot of public demand for these types of investments, so it appears that it's going to remain here on the horizon. In terms of valuation and pricing, again, touching on a lot of the things that we've touched before. Stabilization in a number of these different factors we're starting to see. Inflation has begun to ease. So more than anything, it turns into whether or not we have the ability to understand how that inflation can be borne either by the company, by any type of downstream market or customer. The lending environment is going to continue to impact financing costs. So how will this change? Again, we think it's going to decrease eventually, but we may find ourselves in a new normal. Will we ever get back to the interest rates that we saw 3 years ago, 4 years ago? We don't know. I don't think that it's going to stay where it is today forever. So that will impact, obviously, that alternative investment and the required rate of return that Melissa talked about. Still see supply chain issues. I don't know that I've seen any reason to think that those are coming to an end anytime soon. That geopolitical issues that Melissa talked about, especially internationally, we're going to continue to see issues in that vein. Then labor markets are going to remain tight. So a lot of these factors need to go into how we properly quantify that normalized earnings stream, that normalized EBITDA, whenever we're doing the diligence for a transaction. As those lending rates do calm, multiples should stabilize. The multiples that were jumping around on those first slides hopefully kind of stabilize the way that we had seen in years prior. Companies have adjusted their prices to offset inflation, or at least have a better idea of the willingness of their customers to accept pricing increases. They found hopefully a new market and have been able to kind of wade through that in line or in recognition of the inflation curbing a little bit compared to where it was a year ago. And finally, as earnings steady, the perceived risk of the volatility in earnings should decrease. So as an investor, I see less risk with there being these swings in earnings directly involved from inflation, supply chain issues, those kind of things. So in what time frame should we see that stabilization? That's a little bit more difficult to understand, but we expect there will be a little bit more stabilization on both sides of our valuation equation, the earnings side and the required rate of return.
I think, Brad, before you close down, what can be gleaned from our presentation based on what we do, because I think everybody in the room has probably heard us say, value is always forward-looking. It really doesn't matter what has happened in the past, only if it's a proxy for the future. But as you could tell, sitting in our seats and working with our clients when, during times of uncertainty on both sides, company side as well as the lending environment side, it's very difficult to say, well, what do you expect in the next 24, 36 months? And our clients are like, so it's been challenging times. I think we've worked very well with our clients in, trying to come up with solid assumptions, looking at sensitivity to those assumptions over time. But, for the time being, with some of our clients, we're shortening the forecast period because, you get out beyond 3 years, trying to get out to 5 years, and, our clients, they'll sit there like mind blown. But hopefully you can get some appreciation for, kind of what we do on a daily basis.
Yeah, so just in closing, I do want to reiterate our thanks across our service groups. We appreciate, the support that you have, your attendance today, and then the support that you guys have had for our firm across all 4 of our service groups. So thank you.